I'd like to welcome all of you here in part 3 of a series regarding impact investing. And our hosts of the presentation today will be Megan Morris and Danielle Salal, who are both alumni of Presidio Graduate School and are employees of HIP Investors. So if you want to learn any more about Presidio Graduate School or HIP Investor, please reach out to either all of us, and we will be happy to answer any questions you have on that. If you joined us for our first 2 webinars, the first one was an overview of impact investing, and the second was incorporating your ESG across asset classes. And today we're going to be talking about sustainable 401ks and what are your options. So thank you for joining us. We really appreciate you being here. And I'm going to pass it on now to Megan here, who's going to be talking a little bit more about your sustainable 401k.
Hi, everyone. Next slide, please. So first of all, just a disclaimer that this presentation today is for educational purposes and is not investment advice. Next slide. So today I would like to actually start out the presentation by introducing one of our 401k partners, Monty from Money Intelligence, and he's somebody that you'll hear a little bit more about how we work with him in detail later in the presentation, but he's going to start us off just to make sure everyone is on the same page by going over some 401k basics for people to think about as they participate in their 401k plan. So Monty, could take it away. He might be one of the phone that's muted. 408.
Perfect. Can you guys hear me?
Yes.
All right, great. Thank you, everyone. It's a pleasure to be here, and thank you, Megan, for having me. I think as you guys see, the 401k market is a huge market. It's $5.1 trillion, and I don't think that surprises anybody. As being the primary vehicle that Americans save through, naturally it's just going to accumulate a lot of assets. But I think what would surprise a lot of you is as big as the 401k market is, with 91 million Americans participating and having over $5 trillion of investable assets, there are still 5 million businesses in America that don't offer 401k plans. That's about 86% of businesses in this country. And so if you think about, how do we make 401k plans and retirements more accessible to everyday businesses, there's still a huge opportunity there. On the other side, there's 91 million Americans that have access to retirement plans. If you kind of think about how many adults there are, those 91 million are kind of, it's not exactly, it's approximately 50% of, the total adult population has access to retirement plans. So, as big as the market is, there's still a huge population of Americans that really have no access to retirement. And really that's leading to a lot of the social problems we have in terms of people being able to save, people being able to provide for their own retirements. We all know that Social Security is a great program, but it's not going to be enough to provide for ourselves. So as we go through this presentation and Megan talks about the great work that HIP Investor is going to do around making sustainable 401k plans and sustainable investments, just keep that in the back of your head that while it's a huge market, there's still a lot of work to do in terms of making 401k plans accessible to everybody. I think on the other side, related to that same point is, well, there's a number of Americans that don't have access to 401k plans. This is a particularly important issue because, we're all living longer. And so the right way to read this slide is the light blue is men, the dark blue is women, and, the light blue is men, the orange is women, and the dark blue would be either you or your spouse. And so this slide says, if you live to be age 65, what is the probability that you live to be age 95, 85, or 75? If there's one number I think everyone should focus on, it's the probability that either you or your spouse is going to live to be age 95 in retirement. And it's approximately 50%. So as we're living longer, it's becoming increasingly more important that we provide for ourselves. Dovetail that with the fact that, half of us don't have access to retirement plans. Social Security is extremely uncertain, particularly for those of us who are younger. It's going to be becoming even more important that we take control of our own destiny, that we save for ourselves, and that we really help businesses offer some sort of retirement plan, whether it's a 401k plan or a different kind, to their employees. And so, it's just as we live longer, and this slide was put together in 2001, the problem's only getting worse. We're all living longer. There's medical advancements we don't even know about. They're saying that if someone our age today, someone who's 25 or 30 years old, could live to be well over 100. And so it just all becomes more important that we find some mechanism that we be able to provide for our own retirements, that we don't live in poverty, and that we, if something happens to us or something happens to our spouse, that there's enough money there to provide for a comfortable lifestyle. And so just keeping those two slides as a background and a context for the landscape of our retirements and our personal finances, why are 401k plans great vehicles for us to save for our own retirements? And I think a lot of people, when they think of 401k plans, for those who are familiar, think most of a traditional 401k plan or a pre-tax 401k plan. They're really two words that describe the same thing. But a lot of people really don't think about the Roth 401k plan, particularly when people go through. I think a lot of people naturally try to save as much as they can. If their company offers a 401k plan, they'll try to put as much of their paycheck away. They also think a lot about their investments, whether they're investment experts or not. They'll ask a family member, they'll ask a colleague, they'll try to do some research on their own. People put a lot of work into those areas. But what people really don't think about is the tax treatment of their 401k plans. And that's really what the traditional or Roth refers to. So most Americans should be contributing to a Roth 401k plan. I think a number of these mutual fund families do studies repeatedly, and they find that about 80% of Americans should actually be contributing to a Roth 401k plan. Well, what they find is just because of the familiarity of the pre-tax, the temptation of getting a tax break up front, something like 90% of Americans are actually contributing to a traditional or pre-tax 401k plan. So it's probably it is the most misunderstood decision within 401k plans. And actually, because the tax treatment is so different, can have a huge difference in the effective income that you have for your retirement. So what is that difference? The traditional is what all of you are probably familiar with when you think of a 401k plan. I earn money from my company. Let's just make the math easy. I might earn $1,000 per pay cycle. I put $100 of that $1,000 away. I want to be responsible. And because the government wants to incentivize us to save for our retirement, we get a tax break in that pay period and in that year that we make a contribution. So it's really tempting to get tax breaks. I've never met someone who enjoys paying more taxes than less. And so we only pay taxes on $900 of income because we put $100 away in our 401k plan. And when 30 years from now, let's say we're 35, when we retire age 65, that $100 could reasonably grow to about $800. We would draw that. We'll pay ordinary income taxes when we make those distributions from our 401k plan. That's really the traditional model that the 401k plan has been built on. About 12 years ago, the government put in Roth 401k plans as provisions in 401k plans. And this is really what most Americans should be doing when they think of 401k plans. And that's because when you make that contribution on that same $1,000, you're putting $100 in, you actually don't get a tax break in the year you make that contribution. But because you pay the taxes up front, so on that $100, you're paying taxes on the full $1,000 that you earned, the government rewards you by letting all your money go tax-free. So when your $100 turns into $800 at age 65, you can withdraw all $800 tax-free. And it's really a great boon for people who are younger, who have long time horizons for retirement, and people who aren't in really high tax brackets, because if you think of the government tax rate as a subsidy of what the government is contributing to your 401k plan, some of us might be in 15, 20, 25, 30% tax brackets. For every dollar we put in, that tax rate is basically what the government is subsidizing our contributions by, incentivizing us to put money into our 401k plans. If we're not in, really high tax brackets that are 30+%, that benefit of putting money in a pre-tax is less than putting money in a Roth. And so having our money go tax-free becomes more worthwhile. And I think when a lot of people think about their retirements, they think about, I might move to a lower cost state. Over time, I'm going to pay down major expenses like my house and other major personal finances. What we find when we do a lot of personal finance research is that most people don't accomplish these things. Things like paying down your house over time. Most Americans actually don't make significant progress in terms of paying down their house. They don't go sell their house in California and move to a lower cost state like Texas or Florida. And so when we work with our participants about 401k decisions, you should assume that the money you earn today, adjusted for inflation, is what you're going to need in your retirement. That the tax rates you're going to pay may go up, they may go down. But for planning purposes, you should assume that if you're paying a tax rate today, you'll pay a similar tax rate in retirement. And then really determine that basis for whether you should be contributing to a traditional or a pre-tax 401k plan. And like I said, this is probably the most misunderstood decision that Americans make with regards to their 401k plan. But it's most important that it still affects the tax treatment of your money today, retirement, and the effective take-home that you get when you are able to take your money out, and how much effective income you'll actually be able to use, even if you have the same account balance in your retirement. And so there are different kinds of retirement plans in place. A common type of retirement plan for small businesses is a simple IRA. One of the benefits of a simple IRA versus a 401k plan is that it has fewer restrictions and requirements for businesses. So it can be tempting for a business with fewer employees to offer a simple IRA as opposed to a 401k plan. One of the benefits of the 401k plan versus the simple IRA is that employers have more flexibility in terms of designing the plan. So in terms of who can become eligible, how to allow for contributions, in terms of designing a plan that's beneficial for the requirements of the business, how to structure that benefit to match the needs of the employees. A 401k plan has a lot more flexibility. For employees, it also has a lot higher contribution rates. So if you're an employee looking to maximize your retirement contributions from your paycheck, a 401k plan is going to have $18,000 limit contributions in 2017, $18,500 in 2018, whereas a simple IRA is only going to be capped at a much lower contribution rate relative to 401k plans. So IRA plans in general tend to have less restrictions than 401k plans for a business offering them to their employees. But because they're easier to administer, they may be more tempting for smaller businesses. The 401k plans really offer a lot more flexibility, more benefits, and higher contribution limits for employees. Touching on that, one of those benefits that companies and employees get within the 401k plan is the ability to contribute more money to their 401k plans. So in 2017, you can contribute $18,000 if you're under 50, $24,000 if you're over 50. The IRS last week actually announced their new limits for 2018, and they went up by $500. So you can actually contribute $18,500 in 2018. One of the other benefits of 401k plans, and this is something that we don't encourage, but one of the things that really helps in 401k plans is you have the ability to take loans. So the government wants to incentivize you to save for your retirement until age 65. They don't want you touching that money, so they have early termination and early distribution penalties if you withdraw money from your 401k plan before the age of 59.5, which is what they consider retirement age. One way around that, though, is the government allows you to borrow money from your 401k plan. So they say if you take a loan and you pay interest back to your account, as long as you don't fall more than 60 days delinquent on those payments, but they won't charge you a penalty for taking money from your 401k plan. So I think a lot of you are in California. We all know how expensive housing prices can get. You're not limited to taking a loan just for houses, but it tends to be one of the more common scenarios that we see. And it can really be helpful when you have to come up with a down payment of $150,000, $200,000, $250,000 to buy even a basic house here in California. We may not always have that money to be able to borrow $50,000 or 50% of your account balance, whichever is lower, from your 401k account. So from a personal finance point of view, even though we shouldn't necessarily take loans from our 401k accounts, the flexibility to borrow money, to be able to put money away, get that tax break, but then to be able to take that money back out really allows for flexibility that can be attractive to a lot of people. That is available in 401k plans, but may not be available in other types of retirement plans like simple IRAs. And so it's one of the things that just makes 401k plans more attractive from an employee perspective, and something that employees should look at when they're holistically looking to plan their finances. So this is my favorite. This is one of my favorite slides in the whole presentation, because along with doing really cool things in terms of the sustainability and making sure that you're investing in responsible investments that are taking care of the environment and growing, that HIP Investor really help you analyze. There's really simple ways to make a lot of money, and it doesn't involve having to take a lot of risk. It doesn't have to involve putting away a lot of money. I think a lot of the financial industry traditionally tells us that it's very hard to invest and accumulate a lot of money, when in fact it's oftentimes the simplest things that we can do that really help us prepare for our own retirements. So the complexity makes it difficult, but we're going to share the secrets to having $1 million in your 401k account. And it really revolves around a few key factors, none of which are very hard. So first, you want to start as early as possible. So in this example, if you start right off college, you start putting money away at age 22, you put away money for 14 years, and you put away $5,500 per year. So, even if you can't put away the $5,500, you'll learn that even putting away small amounts of money will grow to be large amounts of money over time. So over that 14 years, $5,500 grows to be about $77,000. If you never put in another dollar after the age of 35, that $77,000 will grow to be $1 million if all you do is put it in the S&P 500 index fund that your 401k plan offers. So you don't have to be an investing expert. You don't have to ever watch your investments. You don't have to shift your investments around. If all you do is put that $77,000 in the S&P 500 index fund and you never touch it ever again, like I said, your money will grow to be $1 million by the time you hit age 65 in retirement. On the flip side, if you put in that same $5,500, but you wait until 35 to get started, we've all been there. We want to have fun in our 20s. We want to do all the crazy things. Those 14 years can cost you dearly. Starting at 35, you put in the same $5,500 every year. You put it in for 31 years, so you put it in for more than twice as long. You're going to put in more than twice as much money, $170,500 versus $77,000. Even though you put in more than twice as much, you're only going to have $600,000 putting your money in the same exact S&P 500 index fund than if you started at 22. So the key takeaway from this slide is start as early as you can. Put away as little money or as much money as you can, even if it's only a little bit. Small amounts of money grow to be large amounts of money. And so if you can't afford to put anything away, put $10 away, because if you put $10 away in your paycheck, you'll be able to increase that as you get your next raise, as you get a promotion, as you are able to change your finances around. By prioritizing and having a line item in your budget, you'll be able to increase that over time. So don't be of the attitude that, $10, $20, $100 won't add up to be a lot of money. As we saw in this example, if you start early enough, even $77,000 can turn into $1 million with not a very complex investment strategy. So everyone can be a 401k millionaire. Everyone can reach their retirement goals. It's really just about thinking through the basics and prioritizing yourself in your savings and your financial structure. So I think this is the last slide I'll be presenting, but there are various ways that you can present or you can save in a there are various ways that you can save for your retirement. There's IRA accounts, there's 401k accounts. People always ask us, should I be saving in an IRA account? Should I save in a 401k account? Just some of the human behavior aspects of 401k accounts are reasons why we really like them. And those human behavior aspects are first, you're investing every pay cycle. So for those of us who, I know I'm in the profession, I know how hard this is for me. Money comes into your bank account. It gets really hard to know, given all your priorities, how much should be saved, how much should go for your mortgage, how much should go for various expenses. The great thing about the 401k is it just gets taken right out of your payroll and deposited into the 401k. So, right off the bat, if you're one of those people that has trouble saving money, the 401k plan can be great because automatic savings that gets deposited. The other part of it is from an investment standpoint, and if some of you followed the market in 2016, you saw this, the market can be really volatile. So in 2016, you had the market go down 10% in January and February. It came back to break even by April and June. Britain left the European Union, and the market went down 7%. By September, it hit all-time highs. It goes down a little bit right before the election, and then Donald Trump got elected. And the market's been on a straight line up ever since. And so depending on when you put your money in, you were either really, really happy with your investment results, or you were kind of sad that you put it in at the top of the market. One of the great things about the 401k is you're never getting really the best price, and you're never getting the worst price. You're putting money in every month or every few weeks, depending on how your company's pay cycle is. And that really has great advantages to averaging in over time, not putting your money in at the top, not putting in your money at the bottom, and really helping you grow your money for the long term. Since most of us have 20, 30, 40 years until retirement, it really gives us the best way, both from an automatic savings perspective and averaging into the market, to really grow our money for the long term. And that's really the best way for us to provide for our own retirements. Once we think through the major decisions of how much we're going to save, how much it should be in a Roth or pre-tax, and the investment strategy, the 401k gives us the best vehicle to actually make those investment strategies and deductions happen, compared to something like an IRA plan that you have to set up. You have to continually make your own contributions, and then you have to rebalance and reinvest those manually. It doesn't happen automatically like a 401k plan does.
Great. Thank you so much, Monty. And next we're going to have Danielle speaking a little bit about what's in your 401k. So 90% of millennials want sustainable investing options as part of their 401k, and 80% of the general population is more likely to adopt sustainable investing if they can tailor the impact. So we do see that, besides, as Monty pointed out, just the huge need for Americans to save, there's also a huge opportunity to help engage employees and to help them save more by tapping into what they care about. So the first step really is discovering, what's in your current 401k now, and Danielle's going to go through some tools for that.
Yeah, thanks, Megan. So hopefully we're all brushed up on what 401k basics are. Thanks, Monty, for the quick lecture. So I'm going to talk about some tools that are available to individual investors like yourself. So if you joined us for the first part of our webinar series, you may remember that we covered some tools, and you can go back and rewatch that if you want to check it out. But today we're focusing on tools that can be helped to evaluate the impact of the funds in your 401k. So first, we're starting with a tool called Bloom. So Bloom doesn't help you measure impact, but it just helps you maximize your saving potential from your 401k options. So for a small monthly fee, they'll manage your 401k, and they'll choose the right funds for you to be invested in. They'll rebalance it when necessary based on your own retirement horizon and your risk profile. And they'll do this while minimizing the investment fees you're paying. So they currently manage over $1 billion in assets. They found that 51% of their clients were invested too conservatively in their 401k portfolio before they turned to Bloom. They've been able to reduce fees for about 85% of their clients by an average of a little over $100 per year. But a tool like Bloom really helps you manage the various choices, some of which Monty covered in your 401k, to ensure that you're maximizing your future potential savings. And next, we're gonna jump right into impact. So there are tools that out there for free that help you understand the impact of your investments. We've previously discussed fossil-free funds. You guys might remember. It's a tool built by the nonprofit advocacy group As You Sow. Using this tool, you can search their database of tens of thousands of funds and ETFs to understand your exposure specifically to the fossil fuel supply chain. And they have a couple different measures that you can use to evaluate that. So As You Sow has other tools as well to help you analyze your exposure, including one focused on palm oil. And most recently, they developed their tobacco tool, which is shown here. So as more impact themes emerge as being of particular interest to stakeholders and investors like you guys, more and more of these tools will likely pop up to help investors make informed decisions. So if you have a particular impact theme that's important to you, be vocal about it. Talk to your advisor, talk to advocacy groups like As You Sow, people like HIP Investor, and it's really important to have those preferences be heard. So of course, you can also see some information about funds right on the free version of Morningstar. Morningstar gives a rating out of 5 stars based on the financial performance of the fund. There's plenty of information on their platform about risk and performance. And they also give their Morningstar Sustainability Globe rating out of 5, and that really considers the intention of the portfolio manager in creating the fund. Are they looking at ESG factors, or do they have some type of sustainability criteria in their fund creation process? If you want deeper details on a fund, you can explore our new tool at hipinvestor.com/portal. So a little plug for us. Here you can see the overall HIP rating of a fund on our 0 to 100 score. 0 meaning more exploitative, and 100 closer to 100 being closer to sort of a utopian world of. And so here I just pulled a sample fund rating. You can see the overall rating of this fund, 54.3%, which is pretty good. It's above the 50% cutoff that we tend to think of as being net positive versus net negative. And in our portal, you can see not just fund ratings, but also the underlying ratings of the holdings in the fund, their overall rating, as well as their performance across our HIP pillars of health, wealth, earth, equality, trust, management practices, and products and services. And you can also dig deeper into specific metrics we analyze. So for the overall fund, as well as the underlying holdings, you can see how they rate across metrics such as greenhouse gas emissions, gender and ethnic diversity, lobbying expenditures, and about 30 other metrics that we analyze. So we're currently offering a free 14-day free trial to explore our 75,000 plus impact ratings on corporations, bonds, funds, and ETFs. So if you want to dig deeper into the impact of what's in your 401k, this is a good option for you.
Great, thanks, Danielle. And so for part 3 of the webinar, we're going to go through some different options for employers and what you can do if you work in HR, if you're a small business owner, or if you're someone who has been tasked with the position of figuring out to do with your company's 401k. Why is sustainable 401k? Despite the growth of environmental, social, and government-oriented funds in the wider investment market, the $8.4 trillion in U.S. corporate defined contribution plans, which includes the $5.1 trillion in 401ks that Monty mentioned earlier, does not really reflect this growth, and in fact have barely begun to include ESG funds in their portfolios. As an example, Vanguard reported that only 9% of its employee plans included ESG funds, most of which just offered a single fund rather than a suite of offerings. And there was also a Mercer report that found that only 14% of defined contribution plans had a socially responsible investing fund as an option. So there was also an analysis by Fossil-Free Funds, which Danielle mentioned is put together by As You Sow, and they found that only one option and the 100 largest public company 401ks that was both a socially responsible investment and free of the top 200 coal and oil and gas reserve holders. So, most people on this call understand that there are lots of financial risks that are associated with these different environmental, social, and governance factors. So if your 401k portfolio invests in a lot of fossil fuel producers, then your retirement nest egg could potentially suffer higher risk and potentially lower returns. 401k fiduciaries really need to focus on the forward-looking risks of the funds that their firm is offering and seek to add funds with solutions for the 21st century. It's also, authenticity. We have a lot of clients that, when they're at conferences, when just they're speaking to clients casually, really like to tell them how they align all of their business practices with the company's mission and vision. If you spend all day working to, let's say, fight climate change, and then you invest in your 401k that holds a lot of mutual funds that hold all of these different fossil fuel companies, then you're really negating your impact and what you're doing. There also aren't that many companies that have implemented fully sustainable 401ks. So it's great to be a leader in the field. That also is something that you can, use when you are, we've seen clients get great earned media from this because it is still something that's new and people are paying a lot of attention to. And it's also good for transparency, just for our employees to understand what is in their 401k portfolio. And one of our partners at HIP, Joy Poland, actually has a whole framework to do this, to engage employees, survey them, really figure out what's important to them. And of course, speaking of employee engagement, that's a huge benefit of having a sustainable 401k. There was in June of this year, the consulting company Bovado did a survey of employees inside Fortune 1000 companies, and they found that 74% felt that having socially responsible funds offered through their 401k plans was important. And this is consistent, again, of course, especially among millennials, but really with the desire of all employees to align their own value systems with those in their place of employment. 52% of employees indicated a meaningful effort by their CEO to make a difference on these issues would increase their day-to-day engagement with the business. And these gains in employee engagement can have significant impacts on bottom line growth. Companies that have highly engaged employees have 18% higher productivity, 12% higher customer satisfaction, and most importantly to some, 12% higher profitability. So can go to the next slide. One example, actually go to the next slide. One example, you can go back, that a company that has a lot of Presidians working at it is Stoke. They actually experienced pretty low 401k plan participation rates, with 14% of employees participating in their 401k and an average individual contribution rate of 1.6%. And the company did an investigation into why the current employees were not contributing, and they did find concerns such as what I was mentioning before. It didn't make sense for them to invest their hard-earned money into business models that are destroying the future. And through partnerships with HIP investors, Stoke actually replaced a number of its existing funds with ones that not only scored higher on social and environmental impacts, but also that matched or exceeded historic performance indicators. And the addition of these ESG funds actually helped Stoke increase its plan participation from 14% to 95%, and an average contribution rate from 1.6% to 17% in only 2 years. So figuring out how impactful your current portfolio is can be done even if your company doesn't want to switch financial advisors or the custodian where your money is being held. You still have options. Many retirement plan sponsors actually have a list of approved funds for 401ks with specific requirements, such as the fund has to have a certain amount of assets under management, or a 3-year track record, for example. So even though the list of total available funds might be several hundred securities long, your plan might only offer you 10 to 15 different fund options. So this is actually based on solid behavioral science. Although extensive choice seems appealing, research shows that it actually can hinder motivation to buy and decrease subsequent satisfaction with purchase goods. So several studies have seen employee 401k participation rates fall as the number of options increase, and participation in 401k plans is actually higher in plans that are offering a handful of funds versus plans offering 10 or more options. I don't know if anyone here has read the book Modern Romance by Aziz Ansari, but he goes into some of the behavioral science regarding choice in that, specifically a jam study where they went to a grocery store and showed the people different flavors of jams, and the people that actually were shown fewer flavors were happier with their purchase when they took it home. So he was using that for a dating analogy, not a 401k analogy, but it does all come down to choice. So one way that we've worked with plan sponsors is by applying HIP ratings to the entire universe that is available. You can go back a slide. And so this way, this is a sample of 401k fund choices. Instead of having to change where your 401k is, we can just work with the advisor to see what all the total options are in the universe, rate those options, and then suggest to add and subtract funds based on what their scores are. So your company, doesn't have to do a lot of work. They can keep the money where it is, but we still can push the impact by getting rid of the laggards when it comes to financial performance and impact, and increasing the total score. So, and we've also found that offering sustainable 401k options in 401ks, participants normally aren't overwhelmed by choice because they have a guide for how they want to invest their money. If a 401k plan just offered 300 different funds and expected all the participants to do their research on what they should invest in, then yes, that definitely is overwhelming. But if somebody has an interest in sustainable investing and they want to, see really simple metrics as to where they should be investing, then we actually find that helps people with their choices. It doesn't make it more overwhelming with the amount of information that's out there. And we also, that effect is amplified if the company decides that they do want to set up push button portfolios. So that's something that HIP has done. We've created fossil fuel free models. So for people that just want to answer a couple questions about what their financial risk tolerance is and invest in a portfolio that somebody else has already designed, then we can do that. So for the next slide, just a quick review. 401ks are pretty complicated. There are a lot of different parties involved. There's the employee, who is the plan participant and the investor. There's the employer, which is referred to as the plan sponsor, who also acts as a fiduciary for their employees. There's the record keeper, there's a third-party administrator, there's an investment provider. So it can get pretty easy to get into a lot of different acronyms and a lot of different titles of the different parties involved with a 401k, which is why it's great to work with somebody who is a professional and really understands the field. And so one way that you can integrate impact into your 401k, this is especially great for companies that are setting up a plan for the first time, which many of the companies we work with are smaller mission-driven plans, and they're looking for something that's cost-effective and tech-enabled. And we have a great partnership with Monty and the people at Money Intelligence to provide that exact solution. This is showing a screenshot of the Money Intelligence platform, and it helps give employees retirement advice from picking investments to figuring out how much they need to save for retirement. Just really easily, once somebody registers for an account, they ask employees a series of questions, and that determines what their retirement score is. You can see over here on the right. And then below that, it's a little bit small in the image, but you can also have your HIP impact ratings displayed directly on your portal. So like Danielle mentioned, if you have a goal to get to a HIP score of 50 because you want to not have extractive funds in your portfolio, that's something that you can do when you set it up, or it's something that you can work to by not only checking your retirement score to see if you're on track as far as the money that you're going to be saving for retirement, but you can check your HIP score to try to move, if it is a process for you, to move your funds to the score that you want. And this can also have specific impact themes. So for example, if you want to see the fossil fuel exposure in your portfolio, then that would be displayed in the bottom right there. So we also sometimes we work with people that are interested in a multiple employer plan. And what that is, a MEP is a group of unrelated businesses that combine their 401k plan assets together to leverage the benefits of pricing, operational efficiencies, and fiduciary oversight. So small business owners who have chosen to join a MEP often choose to join as an effective way to manage their 401k responsibilities and risk while still experiencing favorable pricing and administrative support that they would probably not otherwise have access to or receive. Multiple employer plans are commonly offered as an extra benefit through a professional employer association and closely associated professional organizations. We're starting to also work with, various companies that have a theme to them. So a lot of food companies that have come together, and we're starting to see different, besides just the associations, different themes that you can help set up your small business. You can help combine with some other small businesses working in the same field. PEOs can also help business owners increase their productivity by helping them outsource a multitude of human resources tasks that include payroll, benefits, recruiting, training and development, and more. Joining a multiple employer plan can help increase investor confidence and engagement and ultimately lead to better retirement outcomes for today's employees, which is what we're all working for. So really the main benefits of a MEP are efficiency. Many business owners do underestimate the time and effort it takes to properly operate a 401k plan. It's common for them not to realize just how many associated administrative responsibilities are not being done or completed properly. So this is MEP participation is an effective way to outsource a lot of those 401k responsibilities. But again, just depending on the size of your company, there are different federal regulations that you have to follow. So again, that's why working with a professional that understands that does make a lot of sense. And today's regulatory climate has many companies that are hesitant to assume any more risk than necessary, and many business owners are looking to reduce their risk. So participating in a MEP is an excellent way that we can help business owners mitigate their risk in the marketplace and within their business. With a MEP, the PEO or association actually takes over the fiduciary role as the plan sponsor, which helps the business owner's fiduciary liabilities by also relieving them just of a lot of the different administrative responsibilities. So it can be great for small business plans that do want to reduce risks and seek to minimize fiduciary concerns. As compared with the potential cost of sponsoring a retirement plan on their own in the open market, participating in a MEP can help you get a lower or more competitive rate. However, this is definitely something where you are outsourcing the cost of doing a lot of those administrative tasks with a small team. So that's what when you're talking to a professional, really to get an idea of what the costs are versus the benefits to you, it makes a lot of sense. And if you work for a large corporation, a great approach is to bring together all of the leaders in the ESG investing space to form a 5-star team. This is something that we have done at HIP Investor before, where we have formed a consortium of independent retirement plan service providers who do have a deep understanding of sustainable investing in ERISA accounts. So for example, this team you see on the screen actually has combined 70 years of sustainable investment experience and 1.5 billion AUM spread over 1,000 different plans. So by working with a team of various people that are experts in all these roles, you can get the best of all worlds. Combining the record keeping, the third-party administration, the compliance services with that expertise in sustainable investing. Oftentimes, plans that are already working with an existing large financial institution that try to make their 401k more sustainable, unfortunately just realize that the financial institution they're working with does not have the expertise in sustainable investing that they're really looking for. So by pulling together different companies, we can create solutions for whatever a large corporation may need. So some of the potential pushbacks that people have said when they are taking this to their board of directors or their CFO are about fiduciary duty, the risk return on portfolios, and fees. So as far as fiduciary duty goes, the Department of Labor, the DOL, has become aware of the growing body of evidence that shows that ESG considerations directly and significantly impact financial return on investments. It actually issued an interpretive bulletin in 2015 to ERISA, which is the Employee Retirement Income Savings Act. And this bulletin clarifies that ERISA fiduciaries can take ESG factors into economic analysis of investments. Specifically, ESG factors may have a direct relationship to the economic and financial value of the plan's investment. And in such instances, ESG issues are not merely an additional consideration or a tiebreaker, but rather are proper components of the fiduciary's primary analysis of the economic merits of competing investment choices. Further, a fiduciary may incorporate ESG factors into the investment policy statement, so that can be something that your company can declare that is going to be part of the rules for how they invest. And then also integrate ESG related tools, metrics, and analysis to evaluate an investment's risk or return, like what we do with the HIP ratings, or to help you choose among otherwise equal investments. And there still are, critics that say that sustainable investing limits the investment universe and returns from high-performing asset classes. However, we have ample evidence that refutes this. One of my favorite studies to mention is a meta-study of over 2,000 other studies that found that roughly 90% of those 2,000 studies did not see a negative relationship between ESG factors and corporate financial performance. And more significantly, the vast majority of studies reported positive findings, and that positive ESG impact on financial performance does appear stable over time. And again, of course, past performance is no guarantee of future results. But at the end of Q2 this year, the HIP fossil-free balanced growth portfolio, which is a moderate portfolio that is 60% in equity funds and 40% in bond funds, had returned 11.45% net of fees, outperforming the Dow Jones Moderate Risk Portfolio Index Model benchmark return of 10.35%. So it exceeded it by 1.1%, the equivalent of a 10% higher reward for sustainability over the previous 12 months. And as far as 401k fees go, there are a lot of ESG-oriented funds that are actively managed, and they tend to have higher fees than passive indices. However, many of the fees on different ESG funds are decreasing due to the price competition among the different fund providers, the increases in automation, and that is helping the industry scale. So that's not something that is an issue like it used to be in the past. So to wrap up, we, HIP Investor worked with As You Sow and the Divest Invest movement to actually create a petition, and over 21,000 people signed a petition. This petition specifically had a focus on divestment from fossil fuels, but what it did create is it helped us create a toolkit that we give out to people who are interested in changing what they have in their 401k, since it isn't something that you have direct control over like you would with your individual investments, what you have inside an IRA. So it lays out 3 different steps. You know, step 1 is talk to your colleagues and build a coalition to effectively advocate for, you know, new offerings in your 401k plan. It definitely helps to gather your peers and interested coworkers inside your company. If you have a group of, you know, 10 or 12 people, that obviously carries a lot more weight than just one. So one way that we found company, you know, different interested parties get great interest is by sharing the Fossil Free Friends search among different employees, sharing some of these tools, and, you know, just showing your other employees that this is something that you can ask about and there are solutions out there. A lot of times people don't even realize that this is something that they can be asking of their HR person and of their financial professionals. So this is definitely great water cooler conversation. Also, if you have a green team or a sustainability team, this could be I've spoken at companies that have a green team that meets once a month to talk about different issues. So this can be a great topic for a lunch and learn to really go over some of these tools and educate people. Step 2 is to identify the best people in the company to speak to. So if you have a 401k, that the plan administrator, manager, coordinator is a great place to start. There also could be a chief sustainability officer. There could be an employee engagement manager. If you work for a smaller company, you know, you can probably just approach your CFO or CEO directly. But if you work for a larger company, you might actually even have to go onto LinkedIn and, you know, sort of figure out who's in what roles and who the best people to speak to are. And then step 3 is to bring a solution to the table. So, you know, the usual starting point of the conversations is just talking about wanting to reduce the future risk of the 401k choices and wanting to invest in the future that you want to see. How can we enhance our 401k choices? And if you know, maybe you speak to your HR person and what we spoke about, just getting 3 new funds, you know, being able to replace 3 of the worst funds with 3 better funds out of that list to 10 to 15 could be the step that the company is willing to take. It could be a company that is willing to transfer providers to someone that can provide all of the solutions that they want. But speaking to other employees, potentially doing a petition, and just doing some research for what the solutions are at various levels, you know, the sort of small, medium, and large solution can be great. And now I'm going to hand it back over to Carrie, who's going to go over some upcoming super exciting events.
Thanks, Megan. Thanks, Danielle and Monty. This is a really great, I learned a lot today, so I really appreciate that. Fantastic. So some of the upcoming events, attractions we're having. The Marin Sustainable Enterprise Conference. It's the first year. It's going to be something that's been going on in Marin. That's going to be this Thursday. So, you know, mark your calendars, come on down. Presidio Graduate School is going to be having a booth there, as well as many Presidians there. And HIP Investor is also going to be involved with this event.
Yes, that's correct. There's going to be a panel on ESG investing at 3 p.m. So if you can only come for the afternoon or evening, definitely check out the ESG impact investing panel at 3.
Great. And Megan, do you want to talk about FinTech?
Yeah, so actually, I run a meetup group in San Francisco called Mindful Money, and we just try to explore different, different aspects of money that traditionally you don't, whether that's some of the behavioral science that I mentioned and looking at the intersection of psychology and money and why people make the choices they do with their money, what emotions are tied to that, as well as impact investing and how you can use your money for to create social and environmental good. So we're actually having, there's FinTech Week in San Francisco. There's a big conference with Empire Startups on November 14th. And so that whole week, there are a lot of different FinTech meetups that are going on as part of that conference. And so we have partnered with the Presidio Graduate School Impact Investing Club to put on a meetup that Thursday, which is the Thursday before residency, called FinTech for Good, From Investing to Philanthropy. So somebody from Change the World Fund is going to be speaking about their philanthropic platform. Tyler Jackson, another alumni from Presidio, is going to be talking about the low-income investment fund's newly launched note. And then we're also having speakers from Just Invest, which is another investment platform that uses ESG factors, speaking. So definitely after res, if you're a full-time student, come, or if you are a part-time student, you can come and meet a lot of other Presidians at a great event.
Great. And here's a little save the date, December 16th. If you've never made it to our capstone presentation and product and service fair, it is an amazing evening where we're showcasing graduating students and to really talk about their capstone presentation. There are going to be presentations going on, and the students in their third semester are going to be presenting their product and service. So I did want to have you save the date a little bit on that. Also, if you are wanting to hear more about Presidio Graduate School, we do have a virtual open house that's happening tomorrow. I can give you more information about that if you want to contact me directly. I will also, there's other events that are coming on, so always take a look at our events calendar on our website. We're always at different places. You'd be surprised how many Presidians are everywhere. And I know HIP Investors also is involved with quite a few events too, specifically with impact investing. So I want to make sure that you check regularly on both of our websites to find out more information about how else you can get involved with either of us, and that you can reach us directly if you have any specific questions going on.
Awesome.
Great. Well, it looks like we just have a few more minutes left. Does anyone have any quick questions? Anything we want to just sort of wrap up with before we close the session?
Yeah, one of the questions in the chat for anyone that's just listening in was just for our contact information, which is on this slide. But if you are listening and not looking at the screen, you can just reply, if you reach out to any one of us on the call, reply to the email, we'll definitely be able to get you the contact information of who you should speak to. So.
Great, and I put my contact name in there as well. You can also reach me at admissions@presidio.edu if you have questions about Presidio Graduate School.
Great.
Oh, wonderful. Well, I really appreciate everyone joining us today. I hope you came away with some really great tips and some ideas about how you can reinvest or think more closely at your 401k. And I hope that you all are making sound investment decisions. And if you want any more, if you want to reach out more, please do. And we look forward to seeing you on our next webinar. We could potentially be doing another session. So reach out if there's anything specific you want to talk about. Again, we will be recording this, so you'll get a copy of this as well. Great.